Hello, I'm Stuart Welch. I'm a portfolio manager on the domestic team at Alphinity Investment Management, and I'm here today to talk you through the August reporting season, which we've just emerged from, and to pull out some of the key developments and trends and themes that we've witnessed, but through the lens with which we look at markets at Alphinity. So before we get underway, I'd like to give you a bit of an overview about Alphinity and our approach. We have 5 investment strategies across domestic and global, core and sustainable capabilities. We've been operating since 2010, so we've just ticked over our 15th year, although the founders of the business have actually been using the same investment philosophy and process since way back in the early 2000s, so it's tried and tested across a number of different investment cycles. We are 70% owned by staff, so we are strongly aligned with our investors. And one of the other difference compared to some of our peers is that rather than have a typical pyramid type structure, we operate a co-PM model where we have 5 portfolio managers, ably assisted by 2 senior research analysts. All portfolio managers have analyst responsibilities and cover stocks. So it's a many sets of eyes approach, which we think leverages the collective experience and specialist knowledge of each of the portfolio managers. And gets better results ultimately for our clients, but also at the same time reducing a lot of the key person risks and succession planning risks that some firms wrestle with. In the domestic sphere, we have 3 strategies. We start with the Australian Share Fund, off which the other 2 are built. The Australian Share Fund has between 35 to 55 stocks, but typically sits in that low 40s range. And it's always a balanced portfolio, a mix of cyclicals, defensives, growth and value type stocks. The concentrated fund has between 20 to 30 stocks, but typically towards the upper end in the high 20s. And for that particular fund, what we do is we take out the risk positions and the lower conviction stocks and reinvest that extra capital back into the preferred ideas based upon the portfolio weight, and then apply a bit of a risk overlay to make sure that the outcome reflects our underlying fundamental views. The sustainable share strategy is a little different insofar as it has some restrictions on the investable universe. There's some of the hard exclusions you would imagine, including fossil fuels and gold, where we don't see an industrial use case. But in addition, we look for companies that contribute positively towards the United Nations Sustainable Development Goals. Once we've whittled down the universe, we then apply exactly the same investment philosophy and process, which I'll run you through shortly, as we do all the other funds. We have a very strong ESG integration across all of our strategies. We have 3 dedicated resources internally, which allows us to engage with companies directly at a lower level and ensure that all minimum standards from an ESG perspective across all of our investments. At Alphinity, we talk about investing in earnings leadership. And so what exactly is that? It is investing in quality, undervalued companies in or entering an earnings upgrade cycle. Now, that investment philosophy and process is premised on 2 core beliefs that we have at Alphinity. They are both at the bottom of the page there, and the first one is that earnings drive share prices. Importantly, it's changes in earnings expectations which we think drive share prices, and that is a process that's equally relevant to higher growth or lower growth businesses. The second core belief is that those changes in earnings expectations, or earnings revisions as we call them, are serially correlated. Insofar as if you have one earnings upgrade, it increases the probability of you going to get a second, third and fourth earnings upgrade, and likewise on the downside. And we'll certainly pull out a few examples through reporting season which we think demonstrate that. And so that's the lens with which we look at companies. So if you look at this earnings clock, what we call our earnings clock, analysts often oscillate from being overly pessimistic and having to upgrade their numbers. That's the left-hand side of this chart. That's the time that we would like to invest in companies, to being overly optimistic and having to downgrade their forecasts. And that's the right-hand side of this clock. That's a period of time that we try and avoid. Importantly, we think that investment philosophy and process avoids 2 of the most common pitfalls of investing, which is the growth trap, where both earnings expectations and the multiple people are prepared to pay for those earnings are being cut simultaneously, or the growth trap, where there's apparent valuation upside, but it's capped by ongoing earnings downgrades. So what we look for is some sort of confirmation that our earnings upgrade thesis is intact and actually coming through. We think that avoids catching the falling knife. And ultimately, if we are right, we get those earnings upgrades coming through. Often at that point in time, the investment community gets more confident in the underlying fundamentals, their products and services being the right ones for the current market climate. And also management credibility improves as people think that management can actually hit targets and deliver. And often people ascribe a higher PE multiple to those earnings. So often you see both the earnings and the PE multiple ratchet up at the same time. Ultimately, at some point, you get to a position where either through the underlying fundamentals waning or people becoming too overly optimistic and extrapolating growth out into perpetuity, that expectations get stretched. So the sources of earnings upside, those earnings beats or positive earnings revisions are exhausted. Often valuations are stretched at that point, and often management in terms of trying to hit targets are releasing provisions and doing things like that, and so the earnings quality deteriorates. And at that point, we look to get off the train. And I'll show you some of these examples in real life as we go through reporting season. So ultimately, what we try to give investors is a balanced portfolio of companies, growth, cyclical, defensives, that are all getting earnings upgrades. And importantly, we think that delivers better alpha generation and importantly, more consistent alpha generation over time. So what we're looking at here on this chart is whether or not growth or some of the traditional investment styles, growth or value, have outperformed in any given month since we started back in 2010. And we've used the MSCI Australian value and growth indices to determine this. And you can see for each month, whether or not growth has been working or value has been working, or whether or not there's been no discernible pattern. And interestingly, it's about a third. So about a third of the time growth stocks are outperforming, about a third of the time value stocks are outperforming, about a third of the time there's no real discernible pattern. But if you focus on those companies that are getting earnings upgrades, irrespective of whether or not they're growth, value, cyclicals or defensive type stocks, that almost doubles the opportunity set, as you can see there, which importantly increases the alpha generation potential, and also improves the consistency with which that can come through. This is one of the key slides that we talk about at Alphinity, and what this really is demonstrating that we've actually been able to find a portfolio that has had better earnings revisions relative to the broader market. So just explaining what it is, if you start at 2010, when we first started to move along the x-axis, for any given calendar year, if those lines are moving upwards and into positive territory, it indicates that our portfolio got more earnings upgrades relative to the broader index. So if you think about each stock effectively is at its simplest form, reflects expected earnings for next year times by a multiple. This is telling you that at least half of that equation, the earnings piece, is actually increasing faster relative to the market. So where at least half of the equation is working in our favour. And as I'll show you as we go through reporting season, as is often the case, is when companies are beating expectations and increasing their forecasts, often the PE multiple also works in your favour. And importantly, what does that deliver for investors? What we have here is a chart that looks at our cumulative alpha generation for the core fund in the blue line and our concentrated fund in the yellow line. Since the time when we actually started using the investment philosophy and process, when our founders came together back in Alliance Bernstein in the early 2000s. And you can see, importantly, that we've been able to generate alpha over time. I think the other point we're trying to highlight here is the relative consistency with which we've been able to do that. We've used, again, the MSCI Australian value and growth indices to see whether or not it has been a growth or a value market. You can see that we've tried to highlight the growth markets in dark grey and the value markets in light grey. And importantly, we've been able to generate consistent alpha across those different time periods by having a flexible investment philosophy and process which follows that earnings leadership wherever those earnings upgrades are, irrespective of whether or not that's in growth, cyclical, values or defensive type stocks. So jumping into results season. So importantly, during results season, the way in which I would characterise it is things are still tough out there. for companies, but there was some signs of improvement. So overall, if you just look at what happened during results season on the left-hand side of this particular page, you can see that on average, more companies missed F25 expectations than beat. And likewise, more companies had their earnings downgraded for F26 than they had upgraded. And so on average, companies had F26 expectations downgraded about 1.5% during August, as a lot of the outlook statements were pretty cautious. And those earnings downgrades were pretty broad-based. If you look at the chart on the right-hand side, we've looked at the earnings revisions for F26 by sector, and you can see that most sectors are in negative territory. And that on average, there was a 1.5% downgrade. A few sectors landed in positive territory. The insurers and the banks have continued to do well. This is a theme that we've seen over the last 18 months and highlights that there hasn't been a huge change in the earnings leadership over that period. But there were a few signs of positive improvement. And so, for example, we're seeing a stronger consumer. The consumer has continued to spend on travel and electronics, but some new signs of improvement, particularly coming through on the housing side with positive trading updates from people like Adairs, Nick Scali, Harvey Norman. And miners also look a little bit more positive. Whilst they got downgrades here, and you can see they got 2% downgrades, if commodity prices hold where they are today, there's potential for earnings upside in future. And likewise, REITs was the third source of positivity we thought coming through results season, where through a little bit of an improvement in underlying fundamentals, a bit better demand, and not a huge amount of supply at a time when capitalisation rates are coming off, it does look like valuations in that sector have bottomed and are attracting fund flows. Now, in considering the results season, it's always important to consider your starting position. And I think the key point here is that we've entered reporting season with relatively elevated valuations. And you can see here on the right-hand side that the market is trading at over 21 times relative to its history of 16. So it is quite expensive. And the reason for that is that the market has continued to rally over the last few years, driven by largely what's happening offshore. So it's optimism around what's happening with the Mag 7, the AI, the potential for a global easing cycle more recently, while actual earnings in Australia have been a drag. In fact, over the last 3 fiscal years, earnings for the ASX 200 have been negative. And you can see on that left-hand chart there that earnings for the market have actually been a drag to performance, and the entire performance of the market over this period has been driven by a multiple re-rate. So we entered reporting season at a relatively expensive type level, which contributed to some of the volatility, and it was one of the more volatile markets or reporting seasons that we've seen in recent history. On the bottom left chart there, you can see volatility as measured by announcement day stock price moves, and you can see that the August 25 reporting season was the most volatile in recent history. And the word volatility often gets used, and one of the key points we would pull out about that is that a lot of the movements were in line with earnings expectations. If you look at that bottom right-hand chart, which we've borrowed from JP Morgan, it clumps stocks into 3 buckets, whether or not they beat F25 expectations, were in line or missed, and then looks at what happened to the F26 expectation in the green bar and the share price movement in the blue bar. And you can see that the stocks that beat F25 and had better earnings revisions for F26 performed better, with the stocks up 2.9%, whilst the stocks that missed and had earnings downgraded for F26 underperformed by about 6%. One of the other key defining factors, I think, of the reporting season was that there was a lot of large cap blow-ups, and I've listed some of them there. James Hardie, the most spectacular, which we'll go through. But there was a lot of large cap blow-ups, including Woolworths, CSL, Ramsay Healthcare, Reece, just to name a few. But it's also worth noting that about 65% of companies actually reported well and had F26 results either in line or flat versus initial expectations going in, or upgraded. So there was some great stock picking opportunities out there also. Now, this chart just pulls out one of the key themes that we observed during reporting season, which was that the domestic consumer is faring much better than their US counterparts, and looks at two different cyclical stocks, one that's more exposed to Australia, being Qantas, versus James Hardie, which is a building materials company providing fibre cement siding mostly into the US market, which has been struggling with a tough consumer backdrop. So you can see, starting on the left with Qantas, firstly, the domestic consumer is doing reasonably well. So we've seen strong government spending, tax cuts, and a few RBA rate cuts that is supporting an improvement in consumer sentiment. And consumers have continued to spend on travel, as I mentioned before, and we're starting to see an improvement in spend in the housing market as well, as they're responding to those loosening financial conditions. And importantly for Qantas, that meant that strong demand has supported another earnings upgrade for Qantas, and it upgraded earnings. The market actually, given the information they were provided, upgraded earnings about 3% for Qantas, and the share price has responded accordingly. Meanwhile, for James Hardie, consumers in the US are wrestling with tougher financial conditions, tariff uncertainty, stubbornly high mortgage rates, and there's also increased competition in this particular space. And so we've seen earnings downgrades. And in fact, during the most recent reporting season, they downgraded earnings 35%, and the stock price is off probably about 40% since that time. Importantly, we would call out two particular points here, and that is firstly that, if you look at both of these stocks, both on the upside for Qantas and the downside for James Hardie, this wasn't the first upgrade for Qantas. There has been a number of earnings upgrades for Qantas, and it's a lot of the same factors: the strength of consumers' desire to travel, low fuel prices, and the benefits that they're getting from better on-time performance and reinvestment in the fleet have driven that upgrade, and the share price has responded accordingly. So the share price is responding to the earnings upgrades. That's our first core belief, and that there's serial correlation in those earnings upgrades. And you can see that Qantas has been in an earnings upgrade mode for almost 18 months now. And James Hardie, on the downside, a very similar thing in terms of the share price certainly responded to that earnings downgrade, and it wasn't the first earnings downgrade. There is that serial correlation in those earnings downgrades that I mentioned before for a lot of the same factors. And this on this slide just expands that to look at what we've seen in the US building materials market more broadly. So the building materials market, as listed on the stock market, is very US-centric these days after CSR was taken out by Saint-Gobain. And we've seen a lot of the same trends. Reliance manufactures plumbing products, and the US is one of their larger markets. And they downgraded earnings, or had earnings downgraded about 9% off the back of a softer macro environment and larger tariff impact than what people expected. And the share price responded accordingly, was off north of 10% and continuing to trade down. While Reece, on the other hand, is a plumbing supplier. They don't manufacture the goods, but they just distribute them, mostly in Australia and increasingly in the US as well. And that is a stock that had about a 14% earnings downgrade off the back of that softer macro environment, Australian recovery taking longer to come through, and increased competition. And the share price was off a lot more than that, because the market was hoping that they could replicate the store rollout strategy they had in Australia, but the increased competition they're seeing in America makes that store rollout in the US a little bit more challenged. And so again, we're seeing the share price respond to the earnings downgrades, and in fact even more so, as the PE multiple has derated as well. But those earnings downgrades are serially correlated. These earnings downgrades were not the first for both of these companies, because a lot of the same factors have been in play for some time. Now, whilst a lot of attention was given to the large cap blowups, and there certainly were a few in the healthcare space, including Ramsay and CSL, there were some great stock picking opportunities, as I mentioned before, and that was certainly the case in healthcare, with both Ansell and ResMed reporting reasonably well. Ramsay had earnings downgrades off the back of a repricing of a government contract in West Australia, higher nursing costs, taking time to get recovery for that, and adverse mix shift. Again, a lot of those factors have been on display for some time, and we've seen a consistency in that earnings downgrade mode for Ramsay. It's been operating for quite some time now, and the share price certainly responded to that. So again, we're seeing the share price respond, and that serial correlation in earnings downgrades. CSL was one of the most notable misses during reporting season. It only downgraded earnings about 4%. That was largely driven by them questioning the industry growth for their key product, immunoglobulin, noting higher competition both in terms of price and volume in that particular space, and walking away from comments about their margin recovery post-COVID in that particular space because of those two earlier factors contributing as well. And so whilst the earnings downgrade was only about 4%, the share price was off well north of that because there was some information content in that, and the market is increasingly questioning whether or not some of the efficiency benefits they're enjoying at the moment are going to increasingly get competed away rather than flowing to the bottom line. That is often what we see, is where the earnings upgrade or downgrade is amplified by what happened in terms of the PE multiple, because people can read something into the future earnings outlook for the company off the back of that. Ansell was another one where it actually reported quite well and had earnings upgrades, and the share price responded. This is a company that manufactures protective clothing, mostly in Asian markets, and sells into Europe and the US. And so they've been it was probably the only stock in the portfolio that was directly impacted by the Liberation Day tariffs. And the share price did come off around that time. Although on further investigation, we actually didn't see much of an earnings impact. And so we held the position, and in fact, added some back as we led into the reporting season, largely because there is very limited manufacturing in the US. And even with the tariffs as they are today, it's unlikely that it's going to make economic sense to locate that manufacturing in the US, and so prices were likely to go up, and Ansell was likely going to be a net beneficiary of that pricing, and we've certainly seen that come through, and at results we saw their earnings upgrade come through and the share price respond. And so we do find that focus on earnings a very good anchor during some of this noise and volatility, including some of these tariff day announcements. One of the sectors that had particularly interesting stock picking opportunities was the consumer staples sector. And here we've got a couple of charts, much like the others, looking at Coles versus Woolworths. And one of the key themes in this particular space has been that customers have been increasingly value seeking. And in that particular environment, Coles has benefited. Rightly or wrongly, the down sort of advertising campaign has resonated with customers when they've been seeking more bang for their buck, as opposed to Woolworths, the fresh food people, where the perceived premium offering has resonated less well. And on top of that, Coles has actually done a lot better job managing their cost base and don't have some of the challenges from their peripheral businesses that Woolworths do. Coles is entirely focused in Australia, where Woolworths has a New Zealand business that is struggling with a really soft macro environment there and a poor strategic positioning in the middle, and also has the Big W offering, which is struggling against Kmart at this point in time. And so for those reasons, we've seen Coles in an earnings upgrade mode, while Woolworths has been in an earnings downgrade mode over that particular time. And it's important to note that this concept of earnings upgrades and downgrades relative to the market is a relative concept. So whilst it looks like Coles' earnings have been only increasing modestly, over this same period of time, the broader market has been downgrading expectations. And so relatively, it looks particularly attractive. And so what we actually saw during reporting season is more of the same, where the earnings expectations for Coles were increased 3%, and the share price was up 14%, whilst Woolworths downgraded F26 expectations 8%, and the share price was off about 15%. So almost a 30% share price differential between the two of these if you got the earnings right. And importantly, again, it wasn't the first earnings downgrade for Woolworths. And so there's that serial correlation in earnings downgrades, with a lot of the same factors driving those earnings downgrades and the share price responding. So, which is typically what we see. And likewise in the reverse for Coles, where yes, up 3%, but the share price was up 14%. So directionally, the share price is moving in the same direction. Not the first earnings upgrade. We've seen many of upgrades or a relatively better performance to the market for many of the same factors that we mentioned before. One of the other key sectors that gets a lot of attention is certainly banks, and there's a lot of conversation about it. And this is just a chart to look at the relative performance of some of the subsectors within within the market. So you can see the performance of the ASX 200 there over the last 18 or so months, but then disaggregated into banks, resources, and everything else in the industrials bucket. And you can see that banks have been a material outperformer. We've heard a lot of reasons why that is the case, whether or not it's increasing passive management, which we don't quite understand, or is it driven by active managers trying to avoid China initially and then now trying to avoid the US. We actually think it's been more driven by underlying fundamentals. And here what we do is we look at the earnings revisions of the market by sector. So as I mentioned before, the market has delivered negative earnings growth and has had negative earnings revisions over the last 3 years. This just breaks it out by sector. And you can see that the banks and the insurers actually stand out quite materially on this particular chart. So if you start in the top left there, you can see the energy sector has had material earnings downgrades over the last 18 months. Likewise, all the resources companies, industrials, consumer discretionary, consumer staples, and healthcare. So large parts of the economy and the market have had material earnings downgrades over the last couple of years. And if you run across the bottom line there, you can see that one of the sectors, or a couple of the sectors that have really stood out, have been banks. They were getting upgrades most of 2024. There was a bit of a hiatus earlier this year, but we've seen them return to that earnings upgrade mode during reporting season, which was a large part of the reason why the market actually put on 3.5% during August, despite having a pretty tough backdrop otherwise. And likewise, insurers have been pretty impressive from an earnings perspective during that period as well. And so we do think that banks, in a slew of earnings downgrades, have offered a fair bit of earnings certainties. Yes, that's potentially low quality, given that's been driven by lower provisioning requirements, given they raised a lot of provisions for a COVID-inspired downturn that never really arrived. But still earnings certainty no less in a market that has been under a lot of pressure from a downgrading perspective. One of the arguments we hear about banks is valuation, and we certainly agree that banks look expensive, particularly relative to their own history. And we've got a bunch of different valuation charts here. The blue line is the average valuation for the 4 major banks, and you can see that on each of those valuation metrics, they look expensive relative to their own history. I think we would call out a couple of points here. Now, first one being that if you exclude CBA, you end up with a grey line. So yes, they look expensive relative to their own history, but much less so. And I think the second point is, if you look at that bottom right chart, is that the entire market is expensive. So the entire market is trading at 21 times plus relative to a history of 16 times. And so the whole market is expensive. So if you look at the banks ex-CBA relative to the broader market, which is the grey line on the bottom right chart, valuation actually looks more reasonable. And so from our perspective, there's a case there as one of the only sectors getting earnings upgrades, and banks ex-CBA are reasonably valued relative to the broader market. And so we are actually overweight ex-CBA, doing that mostly through NAB and Westpac. And interestingly, during reporting season, they both upgraded earnings about 3 or 4%, and the share price was up about 10% relative during that period. And so that is a strategy that did well during August. Now, and then another important sort of flip side to that coin is what's happening in resources. And this here is a chart that looks at spot prices relative to what analysts are assuming in their particular models, and highlighting whether or not there's earnings upside in particular commodities. Now, if I showed you this chart at any time over the last 2 years, it would have showed earnings downside for all sectors apart from gold. So to now have potential earnings upside reasonably broadly across commodities is relatively new. And it's interesting because, as I showed before, like that resources has been a key laggard, and so it is one of the only sort of value type spaces in the market at the moment. And so this does have potential to support the outlook for the market going forward, should this continue to be. And I think we would just highlight, though, at this point, this chart has been quite volatile. Commodity prices have been quite volatile. And some of these improvements are relatively new. They're quite nascent and fragile. At the moment, the strength in things like lithium, for example, was driven initially by a mine closure in China. We've seen that already largely reverse as that licensing issue has largely been resolved. At the moment, things like iron ore, for example, are dependent upon Chinese exports to offset an otherwise weak domestic market, which doesn't seem to be improving at this point in time. And so whilst there's potential upside here, and we've closed our underweight in iron ore, for example, we still need to see a bit more confirmation, I think, that this is actually continuing to be the case, because it is reasonably fragile at this point in time. And so you have to be cautious, particularly given a lot of the macroeconomic risks that are still out there. So what changes do we make to the portfolio during reporting season, putting that all together? Well, as you could imagine, we've increased or added to existing positions where we've seen where we saw positive results and a continuation of that earnings upgrade cycle, and we expect further earnings upgrades going forward. We've listed a few of those there: A2 Milk, Suncorp, Brambles, Ansell, Coles, Charter Hall, BHP Rio, and the banks in NAB and Westpac. We've trimmed the positions where we thought the results were less impressive, so that was in CSL, QBE, Cube and Telstra, and we've exited some positions where we think that the earnings upgrade cycle is no longer in play, and those are Amcor and Vivo there as well. We've given some brief reasons for those. But importantly, we actually had a decent results season, so of the companies that reported, about 85 or 88% of them had results in line or better than expectations for F25. And over 70% of those that reported had earnings upgrades or flat F26 expectations, which in a downgrading market is a positive outcome. So we've been able to add a little bit more to some of those stocks that I mentioned and reduce some of the positions where we've been less positive. And we've given some of the fundamental reasons there for some of those changes. I've touched on some of those stocks on the way through, but just on the ones that I haven't, A2 Milk, we're reasonably positive on the outlook for that stock, given a strong balance sheet, and we do think that the strategic acquisition that they announced at the result underpins future earnings expectations in terms of new products and increasing vertical integration in the manufacturing side. Suncorp had a strong result, and we do think that some of the assumptions there are reasonably conservative, and the strength in the balance sheet supports future capital management. Brambles provide wooden pallets, and we do think that the future cost out potential there will support earnings going forward, despite weak like-for-like volumes that we're seeing across the market at the moment. Charter Hall is a company that is a fund manager in the property space, and as we're seeing some of those property valuations bottom, as I mentioned before, we're likely to see fund flows into that particular space, and Charter Hall likely a beneficiary of some of that. I talked about how we've now more recently seen upside in iron ore, and that's part of the reason we've added to BHP and Rio to close that underweight in iron ore, while we await some stronger conviction that that earnings upside is likely to come to fruition. And I talked about banks. So where does that leave us from a sector positioning perspective? Here I just look at where we are. If I look at all the different sectors across the market, our positioning in that particular sector today versus 3 months ago. For us, this is very much an output rather than a target. We don't manage this top down, although we obviously look at that from a risk perspective. This is very much an output of us going to wherever that earnings leadership is, irrespective of whether it's growth value, cyclical or defensive companies. And you can see that we are just a little bit underweight the energy space. The metals and mining space, which I sort of touched on previously, needs to be disaggregated as between the different commodities. So we are neutral-ish gold and iron ore, a little bit overweight on the copper space. We're a bit more positive on the underlying fundamentals and supply outlook. And we are otherwise underweight things like lithium and rare earths at this point. Consumer discretionary is a sector that probably stands out a little bit. It looks like we've decreased our position there despite my comments earlier about an improving consumer backdrop, which is true, although I'll just note that that's largely been driven by moving out of some of the more US exposed consumer names such as Aristocrat and focusing more on the domestic names. So there is a bit of a shift internally there. the key overweight that you can obviously see is in the insurance space. We'd make a few comments about that. There's a few different types of stocks in there. So you have Suncorp, which is a more domestic focused general insurer. You got QBE, which is a more global, general but also commercial insurer. And then Medibank, which is a private health insurer. So all quite different sort of exposures. In general, we think that they have strong balance sheets. They benefited from large pricing increases, relatively conservative assumptions, and should continue to see underlying margins improve, which, given the strength of the balance sheet, likely flows back to shareholders. You can see that we've increased our position in real estate off the back of those earlier comments about REITs, some of the valuations bottoming and starting to improve. But otherwise, I might just skip forward and just show you where we see the earnings leadership. So this is our top 10 positions in the portfolio. So this is a good summary of where we see the earnings leadership at the moment and where it's moving. And you can see some of the changes that we've made over the last quarter. Importantly, as I touched on previously, I think that you're seeing a mix of different sectors. You're seeing a mix of different types of stocks. Be it cyclical, defensives, growth or value type names, but all of them with a really strong and positive earnings upgrade story and thesis. And that's ultimately what we try to do, is give you a balanced portfolio that are getting those earnings upgrades. So if you think about that earnings expectations times by a multiple, at least half of that equation, the earnings expectations piece is increasing faster than the market. And ordinarily, whilst we don't focus on the PE multiple piece so much, and that's much more prone to things like sentiment and interest rates and flows and what have you, often what we see, as I demonstrated as we went through reporting season, often that comes along as well. So that's what we try to do, and we think that delivers much more consistent alpha generation over time. And so what sort of portfolio does that give you? Well, I've just compared our portfolio relative to the index here across a bunch of different metrics that people would typically look at. And this is typically what we see, ordinarily the case when we look at the portfolio. If you start on the right-hand side, the portfolio in the dark blue there has slightly higher return on equity and lower gearing. That's the quality aspects that we talk about. And if you focus on earnings, EPS in the middle there, which is a key focus for us, this is often what we typically see, is that earnings expectations 2 years out for our portfolio are lower than the market. But as you come closer into the first year, and the earnings expectations, the earnings revisions come through, our portfolio actually delivers higher earnings growth relative to the index. And that's with a lower PE multiple, as you can see on the left-hand side there, and a similar sort of dividend yield relative to the market. And I'll just leave you with this slide here, which is our performance slide. One of the things we're most pleased about is yes, we've been able to generate alpha over time, but the relative consistency across time periods with which we've been able to do that. And we think that is a reflection of the inherent flexibility within the investment philosophy and process to go to wherever that earnings leadership is in a style agnostic way, irrespective of whether or not it's growth, value, cyclicals or defensive, that are leading from an earnings perspective, so that at least half of that equation, the earnings piece, is increasing faster than the market. So at that point, I'll leave it there. And if you want any further information, please take a look at our website. Everything is available there. And if you do require further information, please don't hesitate to get in contact. Thank you.